Hello. In this video, we're going to consider receivables and long-term assets. All of these are assets of a company. First, let's think about accounts receivable. Accounts receivable are assets for which customers usually buy from us, buy from the company on account. And they pay this bill within 90 days, a lot of times within 30. So there's no interest that accumulates on these. Then let's think about a note receivable. And how is this a little different from an account receivable? Well, a note receivable, usually our business is a lender here. And so there very often is a note and actually a loan type document. Normally this is long term, and so there will usually be an interest rate charged. The thing to think about here is a company that sells cars. You might think about a dealer. The dealer would like to just sell in cash, but normally a person can't pay in cash, so the dealer might well make the customer a loan. You might think of the larger companies like Ford Motor Credit and General Motors too in this vein. Both of these are assets. Accounts receivable, no interest, no note document. Notes receivable, there is interest and there is a loan document. So now let's take a minute and think about bad debt expense. So for either type of account, particularly notes payable, but really either of them could be subject to an allowance. We have to think about the fact that we would never know if a note went bad very quickly because whether it's an account receivable or a note receivable, ordinarily first payment's not due for 30 days. A lot of times an account receivable doesn't really go bad until 60, 90 days or even more. Generally accepted accounting principle says we can't wait until the loan goes bad though before we write it off. That would actually be a violation of the rules, and you might argue that was fraud. So we're going to have to come up with a way to estimate what portion of the new accounts are bad. And I will tell you that the lion's share of bad debt expense is for accounts receivable, and we try to think about these customers who've not paid us in cash, but promised to pay within 30, 60, 90 days. How many of them really won't? So what we have to do here is estimate the bad debt. And I'm going to give you an example. We're going to use something called the percentage of credit sales, which is the most common and the easiest way to estimate bad debt. So first, assume 5% of sales go bad each year. Now the company might know this by actually doing analysis on the real accounts that are actually written off year by year. By definition, we're looking at credit sales. There may be a tiny little bit of cash sales that turn out to be bad when checks bounce, but for the most part, we're talking here about cases where we debited accounts receivable and credited sales, and it turns out the customer will never be able to pay. So again, we can't wait until we find out who doesn't pay. Back to our example, let's imagine that credit sales are 1 million. So if our company believes that 5% go bad each year, we're going to take the million, going to multiply it by 5%, and come up with $50,000 in bad debt. Notice then that our debit here is to bad debt expense, $50,000. And our credit is to allowance for doubtful accounts, $50,000. Notice it's not to accounts receivable, and that's going to be important. Notice here that we are making the argument that the moment the account receivable became bad, even if we didn't know it was bad yet because it wasn't time to collect on it, that's the moment we have to record the bad debt expense to keep the accrual method going. So we're making this profound estimate here that, let's say the minute a customer died, even though the loan wasn't due, at that minute, there was a bad debt. So notice these accounts. They turn out to be important. This is just some sample T accounts of how that transaction might look in T accounts. So first, notice accounts receivable sitting here for $500,000. Remember, net credit sales was $1 million, but the accounts receivable balance is only $500,000. Now imagine that the allowance for doubtful accounts is credited, that's what we saw on the previous page, for $50,000, while bad debt expense is debited for $50,000. Well, the net accounts receivable, and this is what we'd actually record on the balance sheet as accounts receivable, is $450,000. And you see how it shows up in two general ledger accounts. Accounts receivable plus $500,000 on the debit side, allowance for doubtful accounts minus $50,000 because it's on the credit side, net accounts receivable $450,000. Notice then, at any given time, we've not written off any accounts. We didn't want to say we know who was the bad debt because we don't at this point. We just know that of this $500,000 that we expect to collect all of, historically, some of them won't pay. But we don't stop our collection efforts here. Well, let's think for just a minute about long-term assets. And long-term assets are particularly interesting because of what happens with depreciation. So remember that from back in chapter 3 where we dealt with it. We can use the straight line method, and if we depreciate using the straight line method, we've already seen that. It's cost minus salvage value over estimated useful life. This gives us depreciation per period. Could be depreciation for a year, could be depreciation for a month. Units of production is very similar to the straight line method, except we have cost minus salvage value over estimated life in units, not estimated life in actual period. So what we get then is depreciation per unit, and we multiply that by the number of units we use each year. Classic way you could think of this is imagine depreciating a car. We come up with cost minus salvage value over the estimated mileage each year, and then we multiply that number times the actual mileage to get the depreciation. Finally, we can use what's called an accelerated method, and an example would be the double declining balance method. That's the accelerated method. And here we have book value, which is cost minus salvage value. I'm sorry, not salvage value in this case. Book value is just, it's cost minus accumulated depreciation. And at first there is no accumulated depreciation. As we carry through the future years, book value is cost minus accumulated depreciation. So we multiply that times 2 times the straight line rate. And notice the red line coming around. We calculate the straight line rate much as we did at the top, but we're going to multiply it by 2 to take double declining balance. And this gives us depreciation per year under that method. An argument for double declining balance is that a lot of times machines are used up more quickly in the early phase. I like to think of the example of you have 20 cars that a collector uses, and the collector buys one car each year. So on a busy day where all 20 cars are used, a collector has to go, one of the collector associates has to go get the oldest car where the air conditioning doesn't work, the radio isn't playing right, and so on. But if it's a holiday and there's only 2 or 3 collectors out, they race for the new cars. So the new cars get used up faster. Well, let's finish our discussion by thinking of the various types of long-term assets. And as an example, we start with land. And with land, there's no depreciation taken. It is a long-term asset, but we don't believe it depreciates. Building suffers long-term depreciation, usually over about 30 years. Equipment incurs short-term depreciation, usually over 3 to 5 years. Furniture, also short-time depreciation, over 5 to 7 years. Usually natural resources like coal and gas, we say are amortized rather than depreciated. Although we do it much the same way. Typically, natural resources are amortized using the units of production method, where we figure out, for example, how much coal's in a mine, how much gas is in a mine, etc. And then we do cost minus salvage value over however much we think exists in the mine, and we multiply it by the amount we actually mined this year. Finally, intangibles are long-term assets that usually 10 to 30 years. Goodwill and patents are two common examples. And I stress that intangible assets are bought, not built. There's a typo in there. It says not built, but there should have been an L, and it's bought, not built. So the idea is you don't show an asset for goodwill or an asset for patent as you're incurring costs related to them. The only way you get assets for either one is you buy a business that had patents, or you buy a business that had goodwill. Let me know if you have questions on this topic, and good luck.